Hi there, my name is Katie DeVinny. I'm a state and local tax analyst here at Bloomberg Tax, and I'd like to welcome you to the VTax webinar to discuss the sales and use tax results of our 21st annual survey of state tax departments. I'd like to jump right in by introducing our amazing panelists for this year. First, we have Sylvia Dion, founder and managing partner at Prieto Dion Consulting Partners. We have Jim Eads, a principal at Ryan. We have Jeff Friedman, a partner at Evershed Sutherland. During today's webinar, I'm going to provide kind of a brief overview of how to use the survey, and then our excellent experts will be covering the following topics. We'll have some general sales tax nexus standards, economic nexus, nexus enforcement policies, sourcing, sharing economy transactions, marketplaces, and refunds. And before we get into the substantive part of our discussion, I'm just going to give you some information about the survey. This is our 21st annual survey and report. We send our questions out every year to senior tax department officials in all 50 states, DC and New York City, for a total of 52 jurisdictions. And this is really important to note. Our responses are based on the law as of January 1, 2021. That's a big deal this year because we know there are a couple of states who have made some major sales tax nexus changes in the last 6 months. Those will not be reflected in their survey responses. The goal of the survey is to clarify gray areas in state taxation. So we're always looking for questions that surround which areas do you not have enough guidance on, which areas are unclear, and we're also looking to address current trends and emerging issues. So what are the new items that the tax departments haven't really had a chance to provide guidance on yet? In the survey for sales tax, we cover all sorts of nexus questions, marketplaces, sourcing, sharing economy, telework, local sales and use taxes. So everything you'll hear about in today's webinar and more. We also cover corporate income tax and pass-through entities in the survey, and we have webinar offerings for each of those topics this year as well. The full report provides participating states' responses to all of our questions and footnotes with their additional commentary. And I have to say the footnotes are probably the most helpful part of the state's responses. Some of the states really do a fantastic job of providing us a lot of detailed citations and explanations for their answers, and it can be really helpful. We organize the questions by category to allow you to easily compare state responses to the same question. And we include a written analysis of the survey results and related trends. If you are a Bloomberg Tax subscriber, the full survey is available on the state tab when you log into your Bloomberg Tax account. And if you are not, we have a free executive summary available for you to download at the URL on your screen right now. And then just a couple of tips and tricks for using the survey. It provides you with a wealth of information, but it is important to remember that this guidance is not official. It's one State Department official's interpretation of the law as of one day. A lot of these issues, as I said before, are gray areas, so there are just questions that we probably will not all agree with the state's responses to. And I think our practitioners will probably have a few things to say about that. Some tax administrators tend to lean towards things being taxable or nexus creating. So it does create a little bit of a bias in the results. Just like if you only asked tax practitioners, you'd probably get a little bit of a lean in the opposite direction. So those are just things to keep in mind. You may not always agree with the answer, but it is really helpful to know what the Revenue Department is thinking. We think it's great to use the survey responses to gain better insights into emerging trends as well, and that's for practitioners and for state revenue officials. And I'd like to end this part of our presentation by just thanking all of the state tax officials who took the time to answer our survey this year. If you are someone who feels like this survey is very helpful to you, please contact your local state tax department and ask them to respond to our survey next year. And now I'm going to hand things over to Sylvia to kick off our substantive coverage of sales tax nexus standards. Take it away, Sylvia.
Thank you, Katie. That was a great introduction. And I liked your last plug there, asking us practitioners and taxpayers to ask their states to participate, because this is really valuable information. So great plug there at the end. Let's just move on to the next slide, please. We're going to start off with talking about just some very standard sales tax nexus questions that were posed to the states. Questions were basically, is your nexus policy based only on a physical presence, only on an economic presence, or both? Interestingly, there were some results in the survey that were interesting from the standpoint that there were several states, 12, that indicated that their policy is based only on an economic nexus standard. I do want to point out that if you look at some of the footnotes, and if you look at the 3 questions that were asked, some of those responses were somewhat contradictory. So you might have had a state that answered yes, it might have answered no to the only physical presence question, answered yes to the only economic nexus standard question, but then ended up answering yes to both an economic and physical presence question. So there's 3 questions. If you're looking for those specific charts, they're located at pages 270 to 273 of the survey. Next slide, please. Here we have just a bar chart that talks about the results. As I said a little while ago, we had some states that indicated that their nexus policy is strictly based on economic presence now. But if you actually look at the results, the yes/no questions that were asked, the answers that were given, the footnotes, in fact, really the great majority of the states still indicated that their nexus policy was based both on a physical presence and economic nexus. Now here what we have is a great chart put together by the BTAX team that shows the 2021 results as compared to the 2020 results. Now a little while ago, I just wanted to point out that I just mentioned there were 12 states that said their economic nexus policy only applies. But when you look at the map, you'll see that many of the states are in blue. And blue indicates that in 2021, the majority of the states said that both types of policies, both types of standards apply. So that really is the case, despite what we saw with those 12 states saying that only an economic nexus policy applies. Next slide, please. One of the things that I wanted to point out were some of the responses that some of our experts gave to the BTAX team. Again, kind of focusing on what are the states saying. Our policy is based only on a physical presence. Our policy is based only on an economic nexus presence. It's based on both. If you look at that on the surface, some of our experts said, I'm really surprised. I'm really surprised to see that, because physical presence really hasn't been done away with. A couple of our experts, both of them said, I'm a little surprised. I'm a little bit puzzled by that. But one of our other experts said that with a few exceptions, they would expect all states to take the view that sales tax nexus is now based on economic nexus. This particular expert, Matthew Hedstrom, a partner at Alston & Bird, I think he had a pretty good point. He says there are compelling arguments that de minimis physical presence would not be substantial under Wayfair. And when it comes to sales tax, sales tax is not typically focused on a de minimis presence like you see on the corporate income tax side. It's really not it's not codified in a lot of the state statutes as far as sales tax nexus goes. So kind of looking at what is Wayfair saying, you really have to have a substantial presence in the state. And there could be an argument that there's a lot of de minimis physical presence that really would not be considered substantial anymore under Wayfair. But anyway, just wanted to kind of mention what some of our experts were saying here about some really relevant and really pertinent points. Kat, next slide, please, Katie. A couple of things, and this is just really just focusing on the survey itself. The survey is filled with so much relevant, pertinent, applicable information. This is an amazing survey. Footnotes throughout, footnotes that specifically provide guidance that the states are providing, relevant code sections, statutes, etc. One of the nice things that I thought that you guys, and a big bravo to you, the tax team, for doing this, I thought putting together charts at pages 263 to 270 that specifically listed out not only the statutes and regulations to the extent that the state provided that information, but citing the actual statutory section, citing the actual regulatory section, providing the administrative guidance, the technical information releases, court cases. These charts on these pages are really, really valuable. So once again, bravo to the BTAX team for putting these together. Next slide, please. The next section that we're going to be jumping into is economic nexus. There were a lot of relevant and pertinent questions in this year's survey dealing with economic nexus. One of the things that the BTAX team did this year is they added a new question in the economic nexus section and also broke out an existing question dealing with services, whether services are included in the measurement of economic nexus. The new question that they added is a question that dealt with whether sales by affiliates, commonly controlled entities, are included in determining nexus thresholds. Those are two new questions that were added here. One of the things, all of us who are dealing with, economic nexus, it is obviously just a huge thing now. There is such complexity that's been added with the advent of economic nexus. Certainly has not made things any simpler. It's made things much more, complex. The taxpayers are having to deal with just a variety of different rules, dealing with which sales should be included in determining whether the economic nexus threshold have been met, the sales amounts, the transactions amounts, the measurement periods. It has just added a huge level of complexity. And the survey really digs into a lot of these areas. It's a very comprehensive survey in terms of really asking a lot of different questions. So once again, just want to quickly highlight that in addition to looking at the yes/no questions, when you see them on the survey, focus on the footnotes because the footnotes will have a lot of relevant information. Next slide, please. So here we have a bar chart that basically shows the different types of transactions that are included when determining whether economic nexus has been met. I mentioned a minute ago that tax services was broken out into two questions in the 2021 survey, and there was also a new question added for whether sales by affiliated companies enter into the survey. These questions are all of the questions that were asked in the survey. Are these types of sales included when determining whether a company, an out-of-state remote retailer, has nexus in your state? Do you include wholesale sales, tax-exempt sales, such as sales of medical devices that might not be subject to tax in that state, sales of taxable services, sales of non-taxable services, sales of items delivered electronically, sales of intangible property, sales of digital items accessed via the cloud, sales that are conducted on a collecting marketplace. And that's a really, relevant point here, or the point here is that you could have a seller, a retailer, who is making 100% of their sales on a collecting marketplace. 31 states said that those sales are required to be included into the nexus thresholds, determining whether that seller has economic nexus in that state. And as I said a minute ago, sales by affiliated companies. So you've got related companies. You've got, company A, the retailer, making sales into a state. Company B, it's a related party, brother-sister corporation, also making sales into that state. 16 states said that the sales of those two related companies should be counted towards each other's economic nexus threshold. So it's just, again, a lot of complexity, increase in the burden for taxpayers, and just a lot of things to consider. Katie, next slide, please. Here again, we've got some comments from some of our experts, in particular with regard to this new question for affiliates. A couple of our experts have some, pretty strong language. Nicole Johnson, a partner at Blank and Roan, said this is absurd. Sales tax is a transaction-based tax, and the legal entity structure should be respected. Amy Noggett basically said the same thing. It doesn't make sense that you're looking at affiliated entities, their sales are needing to be included in whether the economic nexus thresholds have been met. my perspective was that you're double counting, and you're creating a situation where both entities will now be required to register, report, and remit sales tax, creating some additional administration for the related group of companies. So, certainly a big issue there. I know I was surprised by seeing the number of states that said that 16 states that said affiliated sales would be included in determining the Nexus threshold. So certainly a big issue, and thank you to the BTAX team for including that question this year, because it is really relevant. Katie, next slide, please.
Sure, Sylvia, and I did just want to add, I'm really glad that you pulled those quotes out, because by far, we got the biggest reactions when we surveyed practitioners just on that specific question. I think out of every sales tax question we asked, people universally found that to be shocking, and I won't go as far as saying absurd universally, but definitely felt like it was unfair, double dipping a little bit. So I'm really glad you highlighted that.
Right,
Katie,
exactly. Go ahead, Jim.
Katie and Sylvia, I'm sorry. I just want to point out, if you look at the earlier slide and this one, for anybody who was naive enough to think that after Wayfair, uniformity was going to spread across the land, it has not. Look at the stair steps in front of you here, and look at the different kinds of questions that the states responded distinctly to. So I think the pot of gold that the states wanted when they got the Wayfair decision, they're going after that pot of gold. But everybody should remember in sales tax compliance and litigation that the whole point of all this was to make it easier for multi-state compliance. And while some things have changed, complexity is still there.
Exactly. And that's been one of my thoughts exactly, is, I thought the whole goal was, one of the goals was, more uniformity among the states, but that hasn't been the case at all. And, not only are taxpayers having to grapple with things like what are the thresholds, what are the measurement periods, what sales are included. Now you've got, wait a minute, we've got affiliates that are making sales into the state, and they may need to be included in our analysis too. As we all know, the Wayfair, it's not just online retailers that are impacted by these rules. I think many of us are seeing this now. I know I'm seeing this in my practice, working with a lot more, manufacturing companies, companies that sell digital products. Looking at my manufacturing clients specifically, who are traditionally, a lot of them selling, products that were incorporated into other manufacturers' products. So basically making sales for resale or making sales of component parts that traditionally been making non-taxable sales. Now they're having to deal with Wayfair and Economic Nexus because, it's non-taxable sales for resale, they're included by and large, as we saw on that one slide that we looked at a little while ago. So it's definitely creating a lot more complexity, and a lot more companies are being impacted by these rules. So now kind of focusing on this particular slide here, it's really just a slide that compares the results in 2020 to 2021. For some of the categories, I did not include services because that question was broken out into two questions in 2021, and I did not include the affiliate sales by affiliates. We have the slide next year. That would be something that it'll be an interesting comparison to see how states changed their view from 2021 to 2022. So just a little bit of the same. Katie, let's move on to the next slide. Thank you. This next section here deals with the economic nexus threshold, just a kind of a little bar chart that talks about the different approaches that the states took. One thing I wanted to highlight here is when you look at the survey, it comes to the sales tax section, you've got really two sections. You've got your section on sales tax policies, and you have your section on sales tax nexus creating activities. All of the areas that I've covered so far are in the sales tax policy section. So really, what is the state's policy regarding the measurement period? What is the state's policy regarding sales by affiliates? Here where we're looking at, does exceeding a certain threshold, transaction-wise or sales-wise, create nexus for sales tax purposes. So this is a question that you'll actually find. This particular chart comes from, or the chart was built from the charts that you see at the start of pages 346. So here what we're talking about is, what's the state's position in terms of, is this a nexus creating activity if the out-of-state retailer has exceeded a certain amount of transactions and thresholds? A couple of things I wanted to point out here is that we had two states. By and large, as we all know, when it comes to economic nexus, a great majority of states use that 100,000 sales figure. It could be more than 100,000 sales exceeding 100,000, or 100,000 or more in sales. And BTAX, you'd certainly covered that question by asking, if a out-of-state retailer makes sales of 100,000 or more, it covered every type of situation, whether it's 100,000 or more than 100,000. A couple of states said less than 100,000. Those two states were Louisiana and New Mexico. Louisiana, however, I do want to point out, if you look at the results on page 358, there's a footnote 31 that they essentially reiterate their nexus standard. They say that the threshold is 200 separate transactions or 100,000 in sales. So even though they said less than 100,000, I really think that their result should have been 100,000 or more. Yes. Same thing with New Mexico. So I think by and large what we're seeing here is that 100,000 or more in sales is going to get you to that economic nexus threshold. A lot of the states have the 200 or more transactions. They don't all have that. The other thing I wanted to point out about this chart here is that the 31 states that said that sales of 100,000 or more create nexus in that state. We know that basically almost every state in the United States has an economic nexus standard. Keep in mind that there were several states that did not participate in the survey. Arkansas, Colorado, Maine, New York State, New York City didn't respond at all. Illinois indicated no response on just about every survey question, but what they also did is they footnoted a specific general information letter where I believe they have a lot of the information. So, and then as far as this particular section here, we also had Iowa, Kansas, and Michigan who just simply didn't answer that question. So it's so important to look at the chart, look at the footnotes, look at the responses, so much valuable information in there. One last thing I wanted to point out here, not addressed in the chart, but just sort of a general information. A lot of the states have changed their thresholds since they first enacted their laws. Some of the thresholds have been changing from year to year. Arizona, for example, theirs was 150,000 or more in sales in 2020. It dropped down to 100,000 or more in 2021. There is a relevant footnote to this, footnote 9 on page 357. Tennessee's threshold previously up through the end of September of 2020 was 500,000 or more. Effective October 1st, it dropped down to 100,000 or more. So it's just really important to, again, take all this information and recognize that this is still an evolving area. States are still evolving in terms of how they're approaching things. And as I said, thresholds are changing. Some states are dropping the 200 or more transactions altogether. Wisconsin actually did that effective on, I think in February of this year. There is no longer a 200 or more separate transactions threshold as far as Wisconsin goes. It's only the sales transaction. Now, Katie, on to next slide, please. Next area that we covered, that was covered in the survey that I'm covering here, deals with what period is used to determine if the threshold has been met. Beautiful map here put together by the BTAX team. As you can see, many of the states do use a current or a previous calendar year. I will point out that there were a few states, if you look at the actual survey results, that answered yes to every timeline. So if the question said prior year, they said yes. Current year, yes. Preceding 12 months, yes. Preceding 4 quarters, yes. So, they kind of approached their answers in an interesting way. They said, well, yeah, I guess, last year, current year, that includes the prior 12 months, that includes the last 4 quarters. So the results seem a little bit skewed when you actually look at the survey, but I think this map does a really nice job of really identifying how the states answered. Great map, good information there. Going on to the next slide here. So in addition to, as I just said a little while ago, in addition to some of the questions regarding, the thresholds themselves, the types of sales that need to be included when determining economic nexus, we also have the measurement period to look at. Majority of the states said that it's the current or the prior calendar year. If you look back at the chart, you'll see that Alabama, Michigan, Pennsylvania, and Rhode Island said prior year only. Maryland said current year only. There were 9 states that indicated the measurement period is based on the preceding 12-month period. Have a list of the states right there. Again, you can go back to the map and you'll see that there. Look at the survey results. You'll see that there also. A couple of things I wanted to point out here is that there were a couple of states that based their measurement period on a different time period. And those 2 states were Connecticut and Wisconsin. If you look at the chart on page 278, footnote 9, page 274, footnote 9 on page 274, Connecticut added a footnote that said the 12-month period ending on the September 30th immediately preceding the monthly or quarterly period with respect to which the seller's liability for tax is determined. So Connecticut is a state that does use a different time period. Wisconsin can also use, or let me reword this. Wisconsin is a state that bases its annual period on the taxpayer's fiscal year. And if any of you file Wisconsin sales tax returns, I have several clients that file Wisconsin sales tax returns on an annual basis. The annual return is based on the taxpayer's fiscal year end. So if you look at page 276, there's footnote 39. Wisconsin says the thresholds are based on the retailer's current or previous taxable year for federal income tax purposes. So this is something to kind of make a note of. We're so used to thinking in terms of current or prior calendar year, but Wisconsin actually bases it on a fiscal year. Next slide, please. And here we just have a chart. We have the map. We also have the chart. I won't spend a lot of time on this as I've talked about, some of the results already. Just some more information. Thank you, Katie. Next slide. So just kind of a quick recap slide for the section that we covered so far. I talked about the, kind of the 12 states that indicated economic nexus is the sole nexus standard based on the answers provided. Most of the states, really 33, responded that both a physical and economic nexus standard applies. Physical presence is still very relevant today. And that was really supported when we look at some of the nexus creating activities, the many affirmative responses that were given to the survey in terms of actual physical activities that are occurring in the state. If physical presence is not gone, it's still very much alive and well today. Katie mentioned at the beginning of the intro that in states that might have enacted legislation since January 1st, 2021, were not included in the results. So most of us know now, Florida and Missouri enacted economic nexus laws. They were previously the 2 holdouts that did not have an economic nexus law on the books. They've now enacted legislation. Florida's went into effect on July the 1st. I believe Missouri's does not go into effect until 2023, if I'm correct. We talked a little bit about, kind of the lack of uniformity, the additional complexity that taxpayers and practitioners are having to deal with. The 2021 added a new question on whether affiliates, a very contentious, a very interesting question, in whether the sales of affiliates are to be included in the economic nexus threshold. The 2021 survey expanded the question on whether services are to be included or not included, whether they're taxable or non-taxable, how they impact that economic nexus threshold. And, the taxpayers whose sales are not generally subject to sales tax. I was talking about this a little while ago with some of my manufacturing clients, and there are so many states that are saying that wholesale sales and tax-exempt sales, 24 and 33 states are included in determining economic nexus. So this has created a dilemma for some companies saying, I'll be honest, I've had clients that have said, I'm not making any taxable sales. Why should I worry about this? I'm like, this is what the law says now. And I'm telling you that, you have nexus according to what the law says. So it is definitely creating a dilemma, complexity, and additional issues for taxpayers to deal with, taxpayers and the practitioners to deal with. Okay, next question, Katie, thank you. I'm going to move quickly into these next couple of slides. We've covered the economic nexus in a lot of detail. We'll go very quickly through these so that our other presenters have many slides that they need to go over also. So nexus enforcement policy, this is a question that we've seen, every year. It's an excellent question, asking the states, do you send out nexus questionnaires? What do you require of taxpayers? One of the things I just want to point out about this section here is, in addition to asking that question, and you look at the actual charts, and the charts relating to nexus questionnaires on pages 285 to 287, not only is the question asked, but many of the states actually provided the Nexus questionnaire form number. In some cases, there's a link to the actual Nexus questionnaire where it can be found on their website. So it's very valuable information. Next slide, please, Katie. Trailing Nexus, another question we see year after year. And the states, by and large, are still requiring the taxpayers whose Nexus activities cease to continue filing at least for another year, or at least for the current year, many for another year, some for even longer than that time period. There are a couple of states that basically say, well, it really kind of depends on what the Nexus creating activity is. What was it they were doing? What has ceased happening? They kind of look at it on a case-by-case basis, but trailing Nexus is still an issue, and this is an issue, I think, even more of an issue now with economic nexus. So, you have a taxpayer who, they met the threshold in 1 year, they had economic nexus in that year. Next year, their sales have really dropped. All of a sudden, they find they don't have economic nexus the next year or the year after that. How does the whole trailing nexus kind of come into play there? I think that's just an important consideration. Katie, next slide. Foreign sellers required to collect and remit. Again, an excellent map here put together by the BTAX team. The only thing I want to say here is that this is a big issue for companies located out of the United States. So many of them falsely believe that if the U.S. has a tax treaty with their country, that they're not subject to any type of state tax. Simply not the case. The foreign seller outside of the U.S. making sales to customers in the U.S., you are subject to our rules, sales tax rules. You're subject to economic nexus. It's really a big deal. Next slide, please. This slide is really just sort of highlights that when it comes to the nexus creating activities, I said a little while ago, physical nexus is still very much alive and well. The BTAX team asked the state 123 specific questions that may create nexus, and by and large, there are a lot of states that are still saying that a lot of these activities do create nexus. Next slide, please. Here we talk about telecommuting employees, a really relevant map here, again created by the BTAX team, talking about whether a telecommuting employee creates nexus in the state. That's been a big issue, and a big issue during COVID. But actually, a lot of the states did provide some type of guidance that if the telecommuting employee was telecommuting only because of a state mandate, the governor issued an emergency, got a limiting activity, et cetera. Employees now working from home because it was required by the state. A lot of states did actually provide some type of guidance that said if you have an employee who's telecommuting in the state and they're only telecommuting because of COVID, then that in and of itself is not going to create nexus. But other than that, many states are still saying that if you have a telecommuting employee who's basically they're not there because of COVID, but this is basically the way their work arrangement is organized, they're going to create nexus, even if it's just one single employee. Next slide, please. And here we kind of have a quick recap slide for this section. So I said a little while ago, there's a ton of survey material, 123 activities that were queried on, and by and large, states are really still looking and saying, any type of activity of this nature, state employees coming to the state to do warranty work, to do training, to do repair, delivering tangible personal property in their own vehicles, reimbursing the expenses of an in-state salesperson, coming in for trade shows, especially if the trade show activity leads to sales occurring at the trade show, orders being taken at the trade show. By and large, it's just still seeing, the physical activity driving the nexus question. So that has not gone away. Yes, economic nexus is here. Physical nexus has not gone away. And like I said, it's just become a much more complicated, complex, burdensome, thing for taxpayers and practitioners to deal with. And at this point, I'm just going to go ahead and turn this over to the next speaker.
Thank you, Sylvia. That was a terrific, extensive discussion of the Nexus findings in the Bloomberg survey. A lot of terrific material in there. Just to provide a little bit of a recap as well, we all were focused after Wayfair as to the dollar thresholds and the transaction counts. That was our big focus, how much the states were going to require regarding dollar sales and how many transactions. And then the transaction threshold started falling away. We still had the dollar thresholds moving around all over the place. And then we had all these other variables that you were describing. What time period does one look to? Is it the current year or the previous year? Is it the rolling 12 months, rolling 4 quarters? Is it all of the above, as you noted before? So we have that variable as well. And then how long does it last? Once you have Nexus, how long does it last? And what sales are counted? Is it exempt sales? Is it just taxable sales? Is it sales for resale? What about services? Taxable services, non-taxable services? So I think Jim had it exactly right. Did we accomplish anything from a physical presence Nexus standard that existed pre-Wayfair to what we have today? I hate to say it, and Jim, I'd love to hear your view on this. As a result of all of these Nexus rules that the states have put in place, and frankly, the aggressive interpretations that they're putting in place as well, Nexus is almost less of an issue for a lot of our clients. Basically, our clients have Nexus everywhere these days, it seems like.
Well, Jeff, I think you're right. Nexus is becoming less of a specific concern, but then the complexity actually kicks in once you see that Nexus has started. Whether or not it's going to continue is even, as you point out, one of the questions. So if Nexus is receding as something to worry about, clearly there are a number of other things to worry about, which you pointed out. And while that's good for Bloomberg because people are going to look to Bloomberg for advice, and that's good for Sylvia and you and me because they're going to need to get help to answer these questions sometime. But it misses the strategic mark, which was, let's make this easier for taxpayers to apply. And we're still not there.
Yeah, I'm scarred from that oral argument at the Wayfair case where they talked about an easier standard as a result of what South Dakota did, and I'm not sure we're there. I totally agree. Let's talk about some of the complexities that follow on once we have a taxable presence in the state, and focusing on sourcing. If we could go to the next slide. We have a transaction tax system in this country that is completely non-uniform, and it's getting more and more difficult to track all the changes. But one of the changes I wanted to talk with you about is situsing or sourcing. And there's still 9 states, Jim, that still apply an origin sourcing method versus the more traditional destination sourcing method, at least for intrastate sales that occur within a state, including a state that you're well familiar with, Texas. And I'd just love to hear your view as to why we still have 9 states, and will we still have 9 states 10 years from now, or will origin sourcing ultimately go away?
Well, I think it was Tip O'Neill who said all politics is local. These states reflect that. You're going to talk in a short while about Round Rock in Texas and what Round Rock is looking for. States that either share sales or gross receipts tax revenue with or collect local sales taxes. The cities that benefit from origin love it. And, they don't care that the pie may be enlarged as a result of more taxpayers contributing, their ox is being gored by destination sales. And so if you look at these states, I can tell you, taking the local tax away from municipalities in New Mexico has been a big deal, and will continue to be. So I think if you look at with all of Pennsylvania's local taxes, it's going to continue to be somewhat of an issue there. So what does all that mean for the people who tuned into this webinar to find the answer? Stay tuned for the answer, because it's going to be, once again, a state-by-state approach. And as we can see already in the aftermath of Wayfair, the states are going to take disparate approaches. And if you are sitting by hoping that the Congress will bring some uniformity to this, I have a bridge that I will sell you. That ain't gonna happen.
Hopefully it's not a crumbling bridge, Jim. We definitely have a lot of intrastate origin sourcing on our plate to deal with. The case that Jim alluded to before is a case that was filed in Texas recently in response to a rule change in Texas, a regulation change that would change Texas at the local level from origin sourcing to destination sourcing for intrastate sales as it relates to internet sales. And Round Rock, Texas filed a lawsuit against the state's controller claiming that that change is illegal. And Round Rock has a significant interest in origin sourcing. And they talk about this, they describe it in the complaint that they filed. And what Round Rock described in the complaint was the fact that Dell Computer has a large facility in Round Rock, Texas, and Round Rock benefits from origin sourcing of sales tax because of that Dell facility in Round Rock. And that if this rule change occurs, then Round Rock's going to lose all of that local sales tax revenue and would injure Round Rock pretty significantly. So stay tuned on that litigation. I suspect by this time next year, we may have some further developments on that case. If we go to the next slide, here's a depiction of the intrastate sales. Now, I always like to think that Bloomberg Tax asks all the right questions, but we don't always get all the right answers from the states, as Katie noted at the outset. And one of the kind of interesting and maybe confusing responses is California. So California generally uses destination sales, as do most states, but there is a lot of origin sourcing within the California at the local tax level. So just be wary about some of the results that you get. Sometimes the state tax officials fill out the surveys and don't always think about the local tax consequences within their states as well. Just wanted to flag that. Go to the next slide. An old topic. Frankly, I'm surprised we're still talking about it, but here we are. And that relates to software. Historically, states would only tax canned software that was sold in tangible form on a floppy disk or a CD-ROM or a DVD. And then over time, of course, that has changed, and it is still changing. So more and more states were taxing not only the tangible delivery of canned software, but also the electronic delivery of software. There's still several states, 13 states, that look to the method of delivery to determine taxability. And many of our favorite example of this characterization is California. California to this day does not tax electronically delivered software. If you buy software in California that's canned, get it electronically, you avoid the California sales tax. If you go into a retailer and buy it off the shelf in tangible form, it's going to be subject to sales tax. So that dichotomy still exists to this day, and that number of states has been dropping over time. Maryland just this year, I'll refer to Maryland a few times, went through a pretty substantial law change. And one of the changes they put in place was taxing electronically delivered software, in addition to the off-the-shelf software as well. Next slide. How to source or cite as digital transactions? There's a number of terrific answers and questions in this survey devoted to sourcing of all types of digital transactions, including things such as streaming services. Now, not every state is taxing streaming services, but those states that are taxing streaming services can't figure out how to do it. There's a lot of diverse decisions. There's a lot of no answers, frankly, in this survey, because I think that the states still are trying to figure out how best to tax streaming services. I suspect that these answers will evolve in future years. And one thing that I'd like us to consider in future survey questions is asking the states to identify whether they're tracking the streamlined sales tax approach for citusing. Now, the streamlined sales tax project is an effort by states, a number of states, but certainly not all the states, to come up with a uniform method of imposing sales tax, not necessarily from a taxability perspective, but things like sourcing and citusing is governed by the streamlined sales tax project, and it's reflected in a number of the footnotes in the Bloomberg Tax Survey, including citusing, which in the streamlined sales tax way of thinking is typically a cascading set of rules, which starts off with citus first to the location of the transaction. If you don't know where that is, if the transaction doesn't occur at the place of the business, then you'll look to a second, a third, a fourth, a fifth. And usually that fifth ultimate default cascading answer is the location of the seller, kind of an origin source method. If the seller and the purchaser aren't in the same place, if you don't have books and records that show where the transaction takes place, or you don't have information as to where the item is being used, you ultimately default to the seller's place of business. And some of those hierarchy is reflected in the answers given by the streamlined sales tax states, where they checked yes to a number of the alternative answers that were provided as to how they cited certain transactions. And that was true here for streaming services. There were 2 states, by the way, that say they look to the location of their servers, of the seller servers. If you're thinking of providing a streaming service, don't put your servers in DC or North Dakota, because that's where they look to for purposes of citusing. I think that's a silly approach, but that was their view, at least as it relates to the survey. But you could see a pretty heavy concentration of states using billing address or location of use, if that's known, which is not always easy to determine.
Yeah, but
go to
Jeff,
the next slide.
ask,
Sorry, Jim. Yes.
Jeff, before you go,
Yeah.
If the states were picking one of these standards, billing address is going to be easy. That's going to maybe be the easiest thing to find, but it seems to me that it falls far short of giving you the right answer, because nothing on this list is more manipulatable than where you sent the bill.
Right.
Oh, well, pay all our bills in New Hampshire, or we pay all our bills in Oregon.
Yes.
I mean, I understand from a what are we going to tax viewpoint, billing address looks like easy. We got that. The auditors can find it. Bam, we're done. But I don't think that comes close to the right answer. And that sort of fits in with what we've been talking about. We have an answer now. Is it better? Well, depends on who's answering the question.
Jim, I think of billing address. I love your point. I think of billing address like cell phone numbers. How many of us have cell phone numbers that relate to a place where we used to live but don't live anymore? If you look at the area code and you were to guess, you'd often be wrong as to where somebody may be. You and I have children, Jim, that live in different states that may have billing addresses where their homes were, but not anymore. And if you use that as a way to determine taxation, you're absolutely right. It's going to be wrong, because they may live in a state where they're actually using a streamed item or a downloaded song. That's different than where they get their credit card bills because they pay their bills online. They don't care where the address is anymore. The problem is, yeah.
I can tell you my grown children like my home address as the billing location for their electronic services.
I bet they do, because they like daddy paying their bill too. But the flip side of this coin is, what is the right answer? And if the right answer is where that item is actually used, how does one actually determine that and then audit it 3 years from now? And, you know, my child might be in school in Tennessee one year and working at an employer in Dallas, Texas the next, and billing address never changed in Potomac, Maryland, but yet their use kind of varied over time. And tracking that, I think, is a nightmare. So this is really a tension between what is administrable and auditable versus what's the, as you were putting it before, the right answer. Really interesting. The next slide touches on that as well. I think we can go to slide maybe 36. I wanted to call out the fact that there are several states that are choosing multiple answers again. And in part, that's reflective of the fact that they may look to different methods depending upon the fact pattern, the information available when they audit, or the type of item being sold, or the type of customer who's actually buying the item. And I find that last point really important. It's probably as good a place as any to mention this. More and more states on audit, and Jim, I'd love to hear your experience with this. More and more states on audit are taking into account a whole number of factors that they may not have in their regulations or in their statutes for determining where to tax electronically delivered or accessed items. We'll get into access here in a bit. And we're seeing more and more states also allowing apportionment of the sales tax base on audit as well. Again, not reflected in the answers to the Bloomberg Tax Survey, not reflected in their rules and regulations or their statutes, but as a practical matter, they're trying to come up with an approach that reflects that real truth you were describing before, the real place of use.
Well, I've never found the real truth, but and that may be an impossible standard to ask the states to adhere to. What you're talking about is the theme that we're talking about on this entire program, and that is the world has changed in terms of the way things are delivered, who uses them, and a tax system that was set up to collect 5 cents on a physical sale in live and in person doesn't as easily fit. And we've got a lot of make-do processes and regulations that the states are doing, and I applaud their willingness to be innovative. But I think what we continue to ask for in behalf of taxpayers is that be innovative, but be clear. You mentioned that they're looking for something that is administrable. Exactly. But administrable includes the concept of voluntary compliance by a taxpayer. States are going to get the revenue that they're looking for if they make it easier for taxpayers to just send it in. If they know what the rule is, if they understand how they can get at it, then they can send in the money. Now, you know, states are still going to audit, but the point is that voluntary compliance is the state's goal, and easy voluntary compliance is the taxpayer's goal.
That is a good recap as to where we are right now and the tensions we're seeing. I'm going to hustle us through some of the other citing and sourcing material. On slide 37, this is a really interesting area, which is available but not delivered canned software. This is a very common business model. It occurs in all different kinds of contexts. And again, putting aside DC and North Dakota as kind of this silly server location response that they're giving us, which I do believe is silly, and talk about something they could really maneuver around. That's one they could easily maneuver around. Customer billing address or where use is the tension we're seeing again, Jim. And even though 4 states are saying customer billing address, I'm seeing a lot more states accepting customer billing address on audit. Again, you know, Bloomberg Tax is asking all the right questions. We're not always getting all the right answers as to what they're doing on audit. And I'll also highlight again the fact that, you know, a lot of apportionment is going on out there. Massachusetts just lost a pretty significant case, the Oracle Microsoft case that was litigated in Massachusetts, where Oracle and Microsoft were allowed to apportion their sales tax on software that was used by its customers all throughout the United States. I think there's a lot more of that apportionment that's going on out there that's being reflected in the responses to the survey. Transition us, if I could, Jim, to sharing economy. One of the really interesting things that came out of the Bloomberg Tax Survey regarding the sharing economy is how significant the answers diverge based upon the industries being focused on. So we're seeing a sharing economy as it relates to accommodations, as it relates to use of cars, whether it's ride sharing or the actual rental, short-term rental of cars, the TaskRabbit and delivery type errand marketplaces. We're seeing a lot of different answers as to who's liable for the tax based upon the industry that we're asking about. And I would like to think, Jim, that over time, there's going to be a harmonization where there'll be some more commonality, whether the platforms are liable or the participants are liable, the sellers are liable, and less dichotomy between industries over time. But it's still relatively new, and I guess we shouldn't be surprised that we see such huge variations as we see on the slide here.
Well, that's exactly right. And harmonization is a term that is used in Europe for their taxes also, and has been used obviously in this country. And I don't think we're seeing a lot of harmony. At least it doesn't sound like it, or look like it. So it is, as we've been discussing, it is a goal, and we're moving towards it slowly.
Absolutely. A little bit of nuance here on this slide. I'm just going to focus in on the first two sets of information or data. On the ride-sharing platforms, we have low state participation, in part because they're not sure what they're doing regarding ride-sharing. But the other significant criteria, and in their defense, as much as it pains me, in the defense of the states, there are a number of states that aren't taxing ride-sharing. So there's a lot of responses is we don't tax this versus answering the question as to which party is liable. So fair enough. Short-term rental platforms is one of the more mature platforms that we've seen in this area, in the sharing economy area. And it's not surprising to see a more robust set of responses from the states. They've given it more thought. And there's been, frankly, more litigation, substantial litigation, as to who's liable for the rental of a house or room in someone's house. You see a pretty significant change over time, but we're up to 27 states now that are putting the tax liability on the platforms. And part of that was negotiated by the platforms themselves. Part of that is as a result of law changes and regulation changes over time. But there's still a number of states, 18 states, that indicate that the provider of the house or the room is liable. You also see if you dig down into the results in the survey and the footnotes that are critical, a lot of dual liability, a lot of states saying we can get it from either. If the platform doesn't fork it over, we're going to go after the homeowner, for instance. So you see a fair amount of that as well. We see some of that kind of spill over into the car sharing platforms, and to a lesser extent to the delivery and the errand platforms, where you see a lot more response regarding no tax, not falling outside of our tax base in those states. So less issues there so far. When we go to the next slide. There's some of the examples. There was just recent legislation in Maryland, not only on the taxability of software and electronically delivered items, but also on the sharing of cars, for instance. They had legislation there on that as well. Georgia's not sure what they're doing. There's a lot of depends in the Georgia responses. It seems like they're keeping their options open, Jim. When I look at Georgia's responses, they want to not necessarily pin themselves down on anything, which is frankly frustrating. And then some examples of homeowners being liable, not looking at the platforms. I see those states as saying, we don't think the platforms are actually providing the accommodation. They're providing a service to those that own the homes, and that service is not taxable. Big distinction, of course, in determining who's liable, whether it's the platform or the homeowner, affects the tax base. Oftentimes what you see is if a state determines that the platform is liable, the service fees charged by the platform sometimes fall into the tax base. If, however, another state determines that the homeowner is liable, then the relevant service fees that are charged by the platform often fall outside of the tax base. So there's consequences here on situsing and the interaction with the tax base. Go to the next slide. Just a quick note on the delivery and errand services. The billing address is an interesting approach because I think it's an attempt, Jim, to mimic what would have happened had there not been a platform involved in the transaction in the first place. I think there's a desire to keep the place of taxation neutral, depending upon, and not change depending upon the use of a platform or just calling the delivery service, for instance, directly outside of a platform. They try to mimic that also with where used, but where used may not be auditable, as we were talking about before, or if it's being used in multiple locations at the same time, there may be some opportunity to apportion the tax base again. If we can go to marketplaces, just going to touch on that before we touch on our last topic of refunds. Sylvia had noted before there's been a lot of evolving law changes by the states after Wayfair as it relates to economic nexus. Same thing is true with marketplaces. Those two issues have been riding shotgun. So you've seen states put in place economic nexus rules and at the same time, or about the same time, put in place rules associated with making marketplaces liable for sales tax collection rather than third-party sellers liable for sales tax collection. So, you know, if you go to the next slide.
If I could just add, I was just going to add one comment on the whole marketplace and economic nexus. As you know, many of the laws did not come into effect at the same time. So you have many states that jumped on the economic nexus bandwagon, enacted their economic nexus law, and then at a later time enacted the marketplace facilitator law. So, you know, you have this disconnect, you know, seller, they've got economic nexus, they, you know, need to register, collect, and let's just say it's a state that later on enacted a marketplace law, but the marketplace says, the nexus law says you don't have to include those marketplace sales. You have taxpayers that's been, you know, having registered for 2-3 months to comply, but then later on don't need to be in compliance anymore. So it just kind of created a lot of, you know, disconnect. The other thing I was going to mention is a lot of the state statutes, if you are trying to figure out are marketplace sales included in the nexus threshold, the language isn't necessarily in the nexus, the economic nexus provision. It's actually in the marketplace facilitator provision.
Great segue for the next slide, Sylvia. Thank you for that. If you could flip there. Yeah, the delayed effective dates are really important to note. There's a couple states that, as Sylvia noted before, that just put in place economic nexus and marketplace statutes that have future effective dates. I also find interesting, guys, that there are a number of states that allow kind of an optionality, I'll call it, regarding who's liable. So there may be kind of a preference in the law or an implied preference in the law. Let's say that the marketplace is liable for the sales tax, but there's an ability for the seller to kind of step back in to the liability and be liable. And you see that in certain industries where a restaurant, for instance, may prefer to continue to collect sales tax on all of its sales, including those that are made through a marketplace, rather than turning their taxation on or off, depending upon whether it's a transaction engaged in by themselves or engaged in through a marketplace. Some other fun facts that we noted here on the slide is that some states are very, very broad, have very broad definitions as to what they think of as marketplaces, including payment processors and advertisers. I find that concerning, and frankly, I'm looking forward to the litigation that's going to arise as a result of those very broad definitions. And then finally, picking up on Sylvia's point, there's a fair amount of dual liability. So there's not only duality as it relates to counting sales for purposes of satisfying the threshold, there's also duality for liability that the marketplace and the third-party seller maintain liability on the tax for that same sale. And I also look forward to that litigation that I'm sure is going to arise when there's some finger pointing that's going to take place between the parties down the road. Anyway,
one
Jen.
more comment out. Sorry about that, Jim. Just one more quick comment out. You know, some of the platforms, to take Amazon, for example, they determine the taxability. If you look at their actual policy, it talks about, first of all, they say you can't opt out, you're a seller. You know, this is the way our policy works. And they're, in some cases, making the taxability decision. So I thought that is interesting that, you know, really taking that power away from the seller. But at the same time, as you just mentioned, you know, situations where a lot of states are saying it's both the marketplace and the sellers that can be held liable, you know, for the uncollected tax.
I think that takes us to sales tax refunds.
Gosh, who's going to talk about that? Sales tax refunds are, as I indicated on the slide, should be simple, but they're not. We have to start with the premise that the tax collector is entitled to and should have as his goal the collection of the right amount of tax, not more than the right amount of tax, even though the governor might really like to have that extra money. So refund claims come in. And then the question becomes, who gets to ask for a refund? Well, really, I understand that in New Mexico, it's the retailer's ultimate obligation. But in New Mexico, that retailer is allowed to pass it on to the purchaser. I understand the Illinois retailer's occupation tax, it's the retailer who has the liability, but they pass it on. So who bears the economic burden of incorrectly paid sales taxes? It's the purchaser. And if you look at the survey, you find that while a lot of states allow the purchaser to file a refund claim, the majority requires that the seller make the claim. Look at the dynamics of that. If the seller has collected the tax and remitted it, the seller is done. The seller is through with that process. The seller has done what the seller is required under the law to do. But if through no fault of the seller, tax was collected incorrectly, who bears that burden? It is the purchaser. And the purchaser, just let me say from my soapbox, the purchaser ought to be allowed to ask for a sales tax refund. But then you get into the next rub, and that is if the purchaser is asking for erroneously collected tax, what is the standard? How much information? Sometimes that information is in the hands of the seller, but most of that information can also be accessed by the purchaser. So what standard does the purchaser who wants his money back have to meet? Well, in one state that shall remain nameless, there is a regulation that says, and I point out that this is 2021, that state says if you're going to prove that you paid that tax, you need to send in canceled checks. How many of you reconcile your canceled checks every month? I read a survey the other day. When do millennials think you're old? You pay with cash, you pay with a check, or you watch network television. Those are the indicators that you're really over the hill. So if a large multi-state company is buying a zillion different things and paying in a batch and doing it all electronically, we don't have any canceled checks. We can't find you any canceled checks. I submit to you that a canceled check would be a great thing to ask for if we were in 1955, but we're not. So I would urge you, if you are a purchaser of goods and you pay a lot of tax and you think you might need some money back, that you have an interest in urging the states to be innovative in how they let those claims be processed and by what standard of proof they can be proven. I think that is all of my soapbox on sales tax refunds. And Katie, by a strange coincidence, we're near the end of our time.
We are. Thank you so much, Jim, for wrapping us up there. And thank you to Jeff and Sylvia today. I think this was a really fantastic discussion. And I'm really appreciative that you all took the time, and I'm appreciative to everybody who took the time to watch. We're not going to go through questions right now because we are definitely at time, but if you have any questions about what you watched today or about Bloomberg tax products, there's a website on your screen, or an email address on your screen right now, taxcx@bloombergindustry.com. That will give you, put you directly in contact with one of our amazing customer experience specialists who will get you the right information or find someone you can. And again, thank you for joining us today, and have a great evening. Bye-bye.